Hello, and welcome to December's Market Insights. I'm Investment Manager Olivia Reid, and I'm here with Director of Investment Craig Melling. The aim of today's session is to look back at the market movements over November before casting our minds ahead to December and into 2026. So, thinking about November, how would you summarise the month, Craig?
It feels like a very long month, doesn't it? And we've seen a lot in November. We've seen extreme volatility. We've seen a US government shutdown. We've seen a U-turn on a U-turn by the UK Chancellor and a leaked budget.
Wow, it certainly sounds like November has been an eventful month. Could you give us a little bit more detail on what happened?
Absolutely. Well, November will be remembered by extreme volatility, as investors were still worried about the high-flying AI stocks and the valuations they command. The tech-heavy US indices were certainly volatile. Just after Nvidia's results, we saw the market up 2.5%, only to finish the day down 2.1%, which is only the third time in history that's happened.
The global spread of volatility is an interesting point and has been described by some as hypersensitivity. It feels like this all started in April with Liberation Day.
Absolutely. If we cast our minds back to April and Liberation Day, the correction we saw then lasted 3 weeks. But actually that was the 8th fastest correction in history. And since then, we've seen markets moving higher, but the volatility has been there. Markets have felt fragile, and the culmination was that in November. And we've seen that volatility really come back in November. If we look at markets, the Japanese market was down 7% to finish the month down around about 4%. The US markets, for all the moving around, actually closed back towards pretty much where they started at the beginning of November. But they've been down as much as 5%, 6%, 7%.
Sounds like it's certainly been a bumpy ride. And why do you think markets are quite so sensitive at the moment?
Yeah, I think if we look at the current market setup, we've seen markets closing at all-time highs. We've got high concentration, we've got high valuations, and this all makes investors feel particularly concerned around any kind of negative news flow. And then sharp bouts of volatility just compound this, and we're moving towards the end of the year, another good year for equity markets. So we've also got to combat profit taking and closure of books for the end of 2025.
Yeah, that being said, it feels like sentiment improved a bit towards the end of November, with investors starting to move past their fears about overvalued companies linked to artificial intelligence.
Yeah, that rebound from lows and the speed of movement in markets is something we've continued to see throughout the year. But the optimism really came back from the Federal Reserve. So the Federal Reserve at the end of November have talked a heck of a lot about a December rate cut, and the chances of that rate cut happening now is over 80%, and that's been very, very good for risk assets.
It's seen quite positively for the US stock market, isn't it?
It is, and I think when we talk about interest rates, that should help US markets, AI stocks, and that broadening out of returns across global equity markets. It's often described the US sneezes, the rest of the world catches a cold. So we will be focusing throughout 2026 on what's going on in the US economy and how that might impact the world globally.
And looking forward to December and into January, do you think this optimism is going to continue?
I think the only certainty is volatility. The markets right now feel fragile. I think this is understandable. We've had another stellar year of good returns. But I think the focus is going to be on earnings. I think that's the key. Can these companies continue to grow their earnings? And that's the big question mark we have now and going into 2026. Right now, we don't have too many recessionary fears. That the global economy is ticking along okay. So earnings are the key, especially when you've seen the concentration we've seen in equity markets, the 7 big stocks in the US delivering big earnings. And if we look at November, Microsoft and Nvidia both delivered stellar numbers, and that wasn't enough for the markets. The demand on earnings from these businesses is high now. So I think that's something we're going to continue to focus on. The market will be focusing on in 2026.
And I think that's a really key point for investors to remember, that despite all the news around policy and politics, that long-term driver of returns for stock markets is company earnings.
It is. And sometimes we get caught up in the macro events. We get caught up in what's going on in the world. But actually, stock markets are driven by share prices, by companies, and the reason their share prices move is their earnings. It's how they are behaving and what they're telling investors and what they're doing. I think one thing we have to think about in 2026 is diversification. We'll continue to see maybe a broadening out of returns as people do worry about the 7 big stocks in the US, their valuations, but AI adoption, the broadening out of the technology, and actually different leaders throughout 2026 could be an option. So diversification really is the key tool for 2026.
And I think that's reflected in the factor exposure we've seen with value stocks and smaller stocks starting to outperform, whereas in November, growth was actually the underperforming factor.
Yeah, it was. I think that broadening out is happening. People are looking away from these businesses and they're looking to position the portfolios and reallocate capital differently. And that might be a trend and a thing we continue to see in 2026.
So we've talked a lot about equities and politics, but what's been going on in bond markets?
So the bond markets are one element that are linked to the macroeconomy. And the UK government bonds experienced significant volatility in November. Why? It's the budget. So Chancellor Rachel Reeves abandoned her first plan to increase income taxes, but investors just didn't take this very positively and sold government bonds. It's uncertainty. People don't like uncertainty. So we saw one of the biggest sell-offs since the summer in UK gilts. Again, this reversed post the budget. So again, it shows you how uncertain, markets and investors don't like uncertainty. So it's been a really volatile month for UK government debt.
So we've talked about the chance of interest rate cuts in the US. What about here in the UK?
So whilst November saw the Bank of England give a cautious stance, with Governor Andrew Bailey actually having the casting vote and deciding to keep the benchmark rate on hold around 4%, the minutes have suggested there is an improved chance that we'll see an interest rate cut in December, and that should settle bond markets.
And I think we're starting to see that come through with the data. Retail sales are slowing, consumers and businesses are cautious, partly because of the budget uncertainty, and it feels like there's that headroom for interest rate cut.
It does. And I think the markets will take that quite positively.
So you've mentioned the UK budget, which I think has been forefront of a lot of our minds here in the UK. What was your view and how was it perceived by markets?
A lot was trialled beforehand. So measures announced were largely expected, meaning limited impact on the UK market, but the onus this year was on employees rather than employers. And while freezing income tax and thresholds were forecast, I think it was a welcomed relief when we finally got the announcement. The Chancellor appeared to appease both her own backbenchers and bond vigilantes. We're talking about bonds being important again and bonds looking at the macroeconomy. But despite spending plans being front-loaded and revenue generation to occur later down the road, markets seem quietly happy right now. And there's been, there was no great surprises in the end, although it was leaked. That was probably a surprise.
That's the biggest
It came out
surprise.
slightly earlier than expected. We expect, further flows into UK stock market as global money kind of repatriates away from those kind of that highly valuated US markets. And I think getting some of the uncertainty of the budget out of the way kind of makes the UK a little bit more investable again. We talk about uncertainty and we talk about what stops people allocating capital. It's just one of those headwinds that's been taken away now, and UK valuations do look attractive.
So it sounds like the UK budget was generally less significant than many had feared. But in the US, they also had their own political drama with a government shutdown that finally ended on the 12th of November.
Yes, the US shutdown, which lasted 43 days and was actually the longest US government shutdown in history, finally ended in November. And although the data blackout wasn't helpful, we should get a better picture over the next coming weeks and coming months around the US economy. The biggest impact actually from the closure was approval ratings for President Trump, which have declined over the 43 days and actually tease us up for the midterm elections next year. So it leads us into an interesting stance with Donald Trump. But for us, we can't focus on what Donald Trump says. He takes up a lot of column inches, but our focus over the next few months is going to be the US economy, because that will impact the global economy. And the kind of things we will be focused on and looking at are inflation and growth. Within growth, we'll be looking at the labour markets and we'll be looking at consumer confidence, spending. Are consumers spending, I suppose, that dollar in their pocket?
We've talked about markets and politics a number of times, but what do investors think about all of this?
Yeah, while politics can lead to movements in asset prices and uncertainty, in the long term, equity markets are driven by earnings of companies, the financial health of companies, rather than political or policy announcements. So as a result, stock markets can rise despite poor economic backdrops. And I think that, as we say, is going to be a continued theme throughout 2026. It's going to really start to focus on those companies themselves, not necessarily what's going on in the wider economy.
And I think that's a really interesting point for investors, because when we hear lots of doom and gloom in the news, doesn't necessarily mean your portfolio's gone down in value. And this year, we've seen good returns across the board, despite a lot of noise and political turmoil.
Yeah, absolutely. This year has been another strong year for equity markets and client portfolios. We've seen a broadening out of returns, which has been very, very positive. It's not just been about 7 stocks in the US, but it's been a really good year for stock markets again, and a really good year for client portfolios.
So, Craig, as chair of Asset Allocation Committee, how does everything we've talked about today feed through to client portfolios?
Yes, so we've got a team of 12 people that meet on a monthly basis to discuss certain key points and focusing on the macroeconomy and where our portfolios are positioned. And through October and into November, we've been talking about taking the portfolios underweight equities, overweight alternatives, and the real reason for going overweight alternatives is to be prudent. And the market feels fragile. We're thinking about the current environment, which sees equities and bonds correlated, and we want to be a little bit cautious and also kind of protect on the downside if we see the market volatility continue.
So, going into 2026, we're going to continue to focus on the economy and on earnings in order to achieve the best outcomes for client portfolios.
Yep, I think to summarize, right now, we're thinking the market is fragile, and this is really due to valuations, but we're watching and monitoring the chances of recession. I think that's going to be a really big theme for us in 2026. But with news flow changing week by week, we need to have clear data points, and we also need to look through the volatility. Diversification is key. Managing emotion is key. And harnessing the long-term power of markets is key. So working on the long-term goals and not getting caught up in the short-term noise is key for 2026.
Wow, it certainly sounds like you've got plenty to be focusing on in the new year.
Absolutely. Pullbacks happen. Stock markets can go up, they can go down. It's all part of investing, but it's the ability to think about the long-term picture. And that's what we're here for. We're here to kind of worry about markets, worry about what's going on, not our clients.
Thanks, Craig. That's been a really good discussion and a nice way to round up the year as we head into the final month. Do you have anything you want to add?
Yeah, the only thing for me to say is a big thank you for the audience and their support throughout 2025. And from everybody here at Progeny, we just want to wish you a very Merry Christmas and a prosperous 2026.
I hope everyone has a great and restful holiday season, and we'll bring you the next episode in January.